All right, stock started the week off on a quiet note. Not very much of a range today. Not very much volume. But there was some interesting moves, regardless of the fact that we didn't really go anywhere. We are in a convergence period, as I mentioned to you for the videos I did last week. That continues to be the case today. Like as I've said before, being in the convergence period doesn't mean that we can't go up. It just, when we do go up, we don't go up very much. And I'm going to show you kind of how that convergence period continues to show up and whether or not we've actually broken out of it or not. So we'll take a look at that. Some big moves in bonds and the dollar today. We'll break those down and see what they look like, how that will impact our market expectations of what do we need to see in those areas for us to get to 4,800 on the S&P, or are we seeing things right now that we really don't want to see? So we'll break that down. Some interesting sector moves today as well, and then our trade idea in the stock has been about as sideways as can be, as sideways as the market has been. This stock has followed that pattern an even tighter range. So we'll talk about how to trade that here. And then again, before we start, just a reminder that our goal is to get our YouTube channel up to 10,000 subscribers. Most of you that are watching, we've noticed, are not subscribers to the channel. So you can click that subscribe button really easy. I'll show you here later. And let's see if we can get up to 10,000. So let's go ahead and get started. Today is Monday, April the 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time on these days. I do the Market Outlook videos. Come down here, click on this heart. It opens up that tab. Click that like button that you'll see right there. And then come here, click the heart or thumbs up icon. It opens up this tab, and you can hit that like button there as well. Again, we dipped a little bit below 100 this time. So this is one of the few times we've been dipping below 100 likes. Again, we always ask every day if you can like these with one or two really easy clicks right now. It helps us. It gets our content out to all of our followers on these platforms. So a very, very easy way for you to support these videos that we put out for you day after day. Thank you to those who do that day after day. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we rallied into towards the highs of Friday, pretty much an inside day, smaller range. The average range right now is 51 points, and we're at 28 today. So small range, not surprising. Kept the near-term line from moving up very much higher. Again, the near-term line unable really to get in the reversal zone without the momentum line getting there first. The momentum line stuck right in the midpoint of the chart. The market sentiment line stuck. So you got both ends of the spectrum here. The very, very short-term momentum line, the very, very long-term market sentiment line, both as flat as a pancake and both sitting right at the midpoint of the chart. Kind of goes to show how sideways we've been. In fact, if you kind of zoom out here, the one-year returns is only minus 6%. That's going to drop pretty rapidly, as you can see. We're going to get really darn close to having pretty flat one-year returns. And by the time we get, if we stay flat right now, within a week, by the time we get to the end of April, where we finish down here at 41.31, we're going to have flat to positive one-year returns. Again, considering that we're in this correction that hasn't bounced yet and hasn't turned into a bear market either, that's pretty significant. This shows how sideways we are right now. And again, also, if you look at like the year-to-date return, we're all green. The 6-month returns 13%, year-to-date's 8%. Green across the board except for that 1 year, which is also, like I said, pretty darn close to turning green itself. So pretty sideways. In fact, in the next couple of days, the 52-week will take about a week, but the 52-week high will be that failed August peak, the pre-Jackson Hole peak. That's going to be the 52-week high, and that's at 43.25, and we're at 41.51. So it's not very far away Again, goes to show just how sideways we've been, that we can be that bullish without necessarily being really that bullish. Because again, if I were to zoom out, obviously it doesn't look nearly as bullish as that 1-year chart would suggest. We talked about last week that barring a big down week this week, which we only have 1 day, that the intermediate line will most likely get in the reversal zone. And well, it has. And again, the near-term line got in there without the momentum line getting there this time. So again, you wonder how much longer the near-term line will be able to stay. And with that, you wonder how long the intermediate line can stay without the near-term line up there. So we'll kind of keep eyes really close to that. But more than likely, again, barring a significant decline, which is very unlikely considering, as you'll see later, how low the VIX is, we're going to have a high point up above 80 on the intermediate line. Again, with market sentiment still in bearish territory, but easily rising here as we are 5% above. You can see, 5%, not necessarily a big number if you follow my cursor all the way to the left here. Well, if I just put it here and you follow all the way to the left, you can see the last time we came off a correction low point in 2020, the COVID lows, we got above 5% pretty easy and stayed above 5% for quite a while. Even in 2019, we got above 5%. Pretty easily, or 5 2/3, which is where this is at, and stayed above it quite a while as well. So here we are, and again, we're not really extending away from the moving average that is rising, dark green shading in the green line. So that's a good pattern. This is a bullish pattern, but it's not quite getting it yet, like say on the Russell 2000, where we got kind of another bear tag situation with light green shading. The yellow line, we're further above the moving average this go around. Remember, you get these bear tags, we really need to take off like right away here in the next couple of days, like we did on the S&P, right? When we got the bear tag on the S&P, we also took off right away when we got that, and that solidified the trend change. So we didn't quite do that a couple of days ago, or at the end of last week. So if we can bust through these highs here, then that would go a long way towards the Russell 2000 finally getting to dark green shading and a green line. Your NASDAQ 100, you can see, was flat. It's the one that's just not really going much of anywhere right now. Market sentiment's already falling. At least the momentum line did spike at the end of last week, so that does help, whereas the other indexes did not show that similar move. And finally, your Dow Jones Industrial Average looks exactly like the S&P. You can't get the momentum line in the reversal zone, but you're also not getting the near-term line in the bearish territory either. So you're kind of bullish. You're bullish, but you're not bullish enough to really be to be breaking out here. As you can see, how far we are. We're only at 3.5%, but we're also not bearish enough to be breaking down either. So not surprising when you got a very small range and you got an inside day and you just don't do much of anything. That's Mondays, when they're lacking any kind of major news announcement, which most Mondays do, tend to be like this, right? Until we get to Tuesday and Wednesday and we start getting, in this week's case, more earnings announcements and things that can provide some volatility for the markets. Let's take a look at the weekly chart. You can see we do have a bullish candle 1 day into the week. We don't have a higher high, but we do have a higher close. Again, we'll see what ends up happening. That would be a very good sign. Again, the Heikin-Ashi candle is a smaller body. As of right now, it's below its moving average, so we're kind of this is suggesting we're in a convergence zone that would lead to a reversal, so keep that in mind. That doesn't mean we have to. We've had times where we did drop and we bounce right back up, so that's been fewer and far between in the past, but it is a possibility that we need to kind of keep an eye on, especially if we break through this real significant resistance level here. Let's take a look at the 3 green arrow charts, and you can see 3 green arrows on the S&P, 3 green arrows on the Dow. We have 1 red arrow on the Qs that's keeping us from having the green shading, and we're back to 3 green arrows again on the Russell 2000. So last time it lasted a day. It needs to last more than just a day, but we're close to really being bullish across the board. Which is what you really want to see if we're going to take off, right, and really get going beyond this 4,200 level up to the upside. This is funny whenever I hear people I heard some guy on TV today on CNBC talk about how he's bullish, but he's not like 4,800. His target's 4,200, and it's like, that's like noise. That's not even a target. That's only 50 points away from here. It's not even that big of a move. And so, I think we get so worked up on the noise up and down. Like as you can see here, we haven't broken above the 78% retracement and stayed there. We haven't broken down below the 23 either. So this is all noise, the ups and the downs and the ups and the downs. The MACD is flirting with converging. You're at the top of the value area. You're forming a node here. There's some massive narrative changing Fibonacci levels, the 78% retracement of that decline, the 50% retracement of the entire correction. Those are really, and then the 23% retracement of the post-COVID, the post-COVID rally. Like all those things, getting above those would be very, very bullish, even more than just any other normal line. So where you see how as we're approaching those important resistance levels, we're getting smaller ranges, smaller volumes, less momentum, possibility of, in convergence patterns across different indicators. You can see the directional movement index. Look at that positive indicator dropping pretty sharply here as we're rallying. It's not below 25, but it's dropping. But as we're rallying, the negative indicator is dropping too to its lowest level that it's seen outside of that August peak. As the ADX is rising there, you look at like the RSI and the CCI setting up for a divergence pattern on the CCI. Big jump above 150 there, but not now. We are still above 60 in the RSI, however, so that's still bullish. You look at the Hull moving average, we're still trading below the 20-day Hull. Again, that's a sign of convergence. You can see the parabolic SARs are really creeping up, suggesting that the possibility of a reversal pattern coming soon on that pattern. Looking at we didn't look at the Ichimoku cloud. Strong, 26-day rate of change. We're above the cloud. We are approaching levels where we're getting intermediate trend strength. We're right on the cusp, but not there yet. And then finally, your Bollinger Bands, you can't get above the Keltner channel, right? You're just riding the top of the Keltner channel. You're not even in the upper quartile. It'll be barely a toe dip into the upper quartile. So it's, again, these are the kind of bullish moves. You can see the bandwidth starting to shrink. The momentum is peaking and rolling over here on the right. So, all these factors is, suggesting that we're kind of exhausting the bullish move that we're on instead of like breaking out per se. Is, some people, you see a lot of people react to a day like today, we're up 1/3% and think, oh, look how bullish we are. And the reality is we're in a noisy pattern. We're converging. At best, we're converging, which means it doesn't mean we can't go up. It just means our upside is very limited versus when you're starting a divergent move and you're just getting going and your upside's got a lot more potential and there's a lot more momentum. You've run out of that momentum and now we're just converging with small volumes and small ranges. You look at today's intraday move, we did not get a new high. We did close near the high of the day, but as I said, it was an inside day. So we had a lower high and a higher low. That can be considered a reversal pattern. Again, we don't have to worry about a significant change in trend, at least in the short term yet, until the green line gets below 70, right? Then you start looking for, a new 4-week low point. But you can see the 4-week low point isn't going to be, an issue for us until, really until we get past this low and starts to move up, So unless we get really significant new highs, as you can see, the gap is so small already as it is, that unless we get new highs, we're going to shrink that gap pretty quickly. And then that, again, if we don't get new highs and the green line drops and we shrink that gap, that's going to open us up for the move, the reversal move to the downside. So something to keep an eye on. As I mentioned, the volumes today, 66 million, less than 3-point range. Those are very, very low numbers when you look at it here. The ATR is at the lowest level the last 52 weeks. In fact, if you go back, you have to go all the way back to really the kind of the end of 2000, right before Thanksgiving, right before this correction started with the Russell. It was the last time we were this low on the ATR. We were below 1% at that time. We're not below. We were at 0.78% at the time. 0.65, 0.78 in that range. We're not that low now, but we're still, at that 1.25 level. So we are, that is one of the lowest levels we've seen in the past year, as we just kind of move our way in. And as you saw, we're just barely above 39. The McClellan oscillator is rising, but not with a whole lot of strength there. So not a lot of breadth. If you look at the money flow, I mentioned before that the index really has jumped up above 70. Not getting above 80 yet, but it's jumped up above 70. So consider that kind of an overbought level, similar to the RSI that can really start moves. You can see it got above 70 when we started this move. It got above 70 over here when we started this move. It got above 70 over here when we started this move. But we've already started this move before it could get above 70, and we're already this far into it. And especially without a real significant increase here in the money flow itself on an absolute basis, again goes to show that we're, again with all the other convergence patterns, that we're just kind of converging here. And you would expect, we've had a green hull for now, probably for about close to 20 days as we approach the entirety of this expiration cycle. That's about the length of time. That was a really long one. That generally you tend to get at least this kind of move in the middle that we didn't get there. So at the very least, you would look for, at the very best for the markets, a very small red red hull as we kind of do this pattern, flip the parabolic stars up, but we don't drop very much. We don't get a new 4-week low, and we just turn right around and go back up again. So something like this, but in reverse. Otherwise, if you go this long without that, then when you do get the reversal, it tends to be a pretty decent period of time. So we haven't dropped yet on the MACD, but it's definitely something to keep an eye on too as we approach the end of the week. And then if you look at the VIX today, dropping below 17, but they're not dropping relative. So we didn't get down to extremes, but 16 below 17. Again, first time we've seen it below 17 in a long time. It is 52-week lows. You have to go all the way back again to before this. We were here. We closed at 19, but on the 4th we closed at 16.91. So we're right about at that same level where we closed when this whole correction started for the S&P 500. Right? That's when the S&P peaked, was on January 3rd, and it started to roll over starting on the 4th, and you can see what happened there. So very small moves as the market moves higher on the VIX, and you can see the VVIX finally kind of breaking below this little range it's been in the last couple of weeks too. Now it gapped down and then rallied throughout the day. So let's see if it can continue to break down and get back down to these levels as the VIX stays down in this area, because again, as I mentioned before, the same thing as what we saw in the early part of 2000 when we had a higher level, even though the VIX was lower, that led to that rally. And so this can be a bullish divergence for volatility, which can lead to a rally in volatility, which is not necessarily the most bullish for equities, especially considering, again, when you look at how low the VIX is on a momentum basis, relative to its average values, it's really low. Like I showed you that on Friday, but you look at it now, and it's still 27% below that 200-day moving average. That's in the second percentile of this past year. It's a pretty low level. If I go back to past 2 years, it's in the 5th percentile. So, relatively speaking, this is we've dropped so far so fast without an equivalent drop necessarily to lower lows in the VVIX. That when we drop this far, this fast in volatility without a nice grind lower, we tend to V-bottom. You can see lots of V-bottoms here. We tend to V-bottom on the VIX, especially when we are as extremely low, not just on the MACD, but when you also include these stochastics as well. When it got extreme, when the orange line got as extremely low, you can see that kind of set the lows on all these other periods here, and we got a rally up. Well, that's where we are again, extremely low on the stochastics and the MACD. Again, you would expect a similar pattern to what we saw all these other instances over the past couple of years. All right, now let's take a look at what's driving this price action here. And you can see the Q's 3-month return still very high relative to what the S&P. The S&P is starting to make a little bit of run here. The IWM still has negative 3-month returns, along with emerging markets down about 4%. But let's just take a look at just today alone. So let's come over here to April 17th, and you can see IWM was the big winner and emerging markets. So you see the biggest losers ended up being bigger winners. The Qs lagged. They were down for most of the day. They ended up finishing positive by the end of the day. The S&P was down most of the day, finished positive. IWM was up the whole day, finished up 1.25%. Remember, they're more closely correlated to financials, which are rebounding pretty nicely. But what really impacted moves were a very strong dollar and a very strong bond yields. Now, in the past, that's been bullish or bearish, for equities. Obviously, not today. Real estate up 2%. So let's take a look at some of the moves that we're seeing in those instruments. The 10-year yield jumping up above its 30-day moving average, so above 3.5% again. Big time jump higher in the 3-year yield, getting above. Like I said, getting above 3.5%, potentially working its way back up above this 3.6%, which is a really important level for it to change directions and get going back to the upside. Which, it's starting to gain some momentum. You're easily above the 17-day moving average now. Your MACD and stochastics are rising up to bullish levels. That generally means, too, that bonds are falling, and you can see bonds have fallen below all these moving averages. The MACD has turned negative. It's below its moving average. Stochastics is dropping. Pretty big drop for TLT. You would expect that would probably continue to drop. Again, that's associated with strength in the dollar. The dollar had been flirting with this 27.5 level again. It bounced off of that. It's barely above its 17-day moving average. The MACD is barely above its moving average. So not a lot of strength there yet. It's actually below its point of control. So, it had to really get some strength to get going. But that's a pretty good move for both those elements. Commodities are still bullish. They've had a nice little run over this expiration cycle. It's also below its point of control. But they're above commodities are above moving average, even though they're losing some momentum and close to converging, but they're at least above their moving averages there. So a good sign. While they are still in correction mode, and that's the other thing too, is bonds are in bear market mode, and they still have been in bear market mode, and generally speaking, stocks will rally as bonds after bonds have rallied, and bonds haven't rallied yet, right? So we haven't had. You can see coming into that COVID low point, bonds were already on an upward trend, and then of course as bonds peaked, that's when stocks started to rally, and stocks rallied off the COVID lows all the way up to really the end of 2021, and then of course that's when bonds and stocks started to fall. Bonds fell into bear market because they had already corrected. Stocks had started to correct and then finished their correction by those October lows over here. We were so far below the moving average. Stocks were just hitting their 200-week moving average, dipping a little bit below it at those lows. So, there's an opportunity here for bonds to kind of fail here at this moving average, weekly moving average no less. Already back below the 17 weeks, only a day, right? We still got 4 more days, but you can see that MACD is looking like it's trying to trend and roll over. The stochastics rolling over. So roll over here would mean long-term bonds yields are rising. Again, that has not been bullish in the past for equities, and that would only rise. You would only have bonds rising as they did today. You can see up to 3.6%, and that's actually doing a nice little number on the yield spread, which is still kind of at 60 basis points here, still well off the 100 basis points low. You can see the 10-year relative to the 3-year improving significantly. This is kind of a bigger move up than we've seen in a while, coming off of some extreme lows there. So that's all coordinating or in conjunction here with an increase in bond interest rate hike expectations. As you can see now, there's an 86% chance that we'll get a rate hike in May. So it's pretty darn likely. It's only a few weeks away here, a couple weeks away. And then you notice that we actually have about a 92% probability of 5.25% in June. So that's up quite a bit from 73 a week ago, from zero a month ago. So big time change in rate hike expectations. Let's go out to the next cycle, where the Fed will, release their projections, that kind of quarterly cycle there. And you can see we have by then you only have a 42% odds of being at 5.25% or higher by September. So now we're starting to get the rate cut odds. And again, 42 is higher than it was a week ago when it was only about 16. So it is, starting to ramp up a little bit. And again, a month ago was at 0. And of course, December, you have a 5% chance. So the market is still full on pricing in rate cuts by the end of the year. Of course, I think, again, if we want to be bullish and if we want to get back to 4,800, we cannot have any rate cuts by the end of the year. The market has to be able to handle these rate hikes and be able to withstand it and keep the market going higher without the rate cuts. Because I don't believe we get rate cuts unless we drop below the 200-week moving average on the S&P. So getting down towards 3,400 or so. And again, if we're doing that, a rate cut will not get us back up. Just like we saw in 73, 74, where we were also dropping. The only other time that we were correcting as the Fed was raising rates, as the Fed started to cut rates after it was already below the 200-week moving average. Again, one of the only times that's ever happened. Those rate cuts were not able to get it going back up. In fact, we just continued into the end of 74, and that's very similar. So we want to avoid that scenario because that would lead to a pretty sharp bear market into the end of this year and next year. An extended period of time below the 200-week moving average. So if we want to stay above it, we do not need rates. We actually want to see these rate hike odds increase without it impacting economic or earnings, and so far so good on that front. So that's kind of what the actual macro case needs to be for us to get back to 4,800. So as you hear people talk about rate cuts, that's going to be a problem. The other issue is, again, as the Fed does continue to raise rates, they're doing it for a reason, because they want to bring inflation down. And as we've talked about, inflation expectations are ramping right back up for April, especially with commodity prices ramping up and yields ramping up, because yields are a reflection of rising inflation expectations. So that's just going to mean that the Fed's going to continue to raise. And to get below 5%, they need to get unemployment rising. And again, that's all associated with recession. So that's the catch-22 we're in the market, is for us to be as bullish as we want to be, we can't have rate hikes or rate cuts. But the more the Fed raises rates, the more they are going to get what they want to get, which is a demand destruction enough to bring inflation down and keep it down with rising unemployment, which we just haven't had yet, right? So that's the idea. So as we see bonds fall back down and we see yields rise again, I think it's going to be. I think these are more a reflection of the fact that inflation expectations are also rising again, and not necessarily what we want to see, as it will just continue to push the Fed to raise rates until it's too late, and to not cut until it's too late, because that's their MO in prior cycles. All right, let's take a quick look at how the sectors have performed over the same time frame. So let's come over here, and you can see the QQQ names and how well they've done here lately. But let's just look at here today alone, April 17th, and we'll go to the 5-minute chart. And we can see real estate, right, did really, really well. But there's your financial. There's why Russell 2000 did so well. Financials did well. Energy was down. Communication services was down. Healthcare was down. So you kind of had a mixed bag, and everything else kind of matching the S&P 500. But the strength obviously coming from real estate and financials. When you look at the 12 grid for these different sectors, you can see we have dark green shading and green line across the board, except for financials, industrials, materials, which energy, which are all still yellow line, dark green shading and yellow line. Real estate kind of in that bag as well, as bullish as it was, because it had been so bearish at the end of last week. Staples, look at Staples, healthcare, utilities as strongly bullish as they are. Again, not on a absolute basis, but just as strong above their moving averages, stronger than just about everybody else right now above their moving average, and not necessarily the leadership you'd like to see, even if their numbers here aren't the biggest numbers. These numbers here that you're seeing, 13.5, 13.8, are a reflection of the strength that they had early in this 3-month period, whereas healthcare and Staples were weak early, and then now they've been very strong late, pretty much stronger than just about everybody. Maybe materials and energy kind of coming in there as well. Some pretty strong moves over the last couple of weeks. Discretionary seems to be kind of in a sideways pattern here lately, and that kind of led me to our trade idea of the day. I wanted to take a look at Costco. Look how sideways Costco has been. I mean, it's, talk about like the 1-year returns. I mean, it's been gradually getting smaller and smaller. These up moves and down moves have been getting smaller and smaller as we trade right around the 30-day moving average there. You can see that reflected as well in the weekly chart. As you are in a death cross, but it's about as small of we're only 0.5% gap here between those moving averages, and the candles are neutral, and the candle sizes are very small. When you look at the 3 green arrow chart for Costco, you can see that we don't have 3 green arrows. We're not trending in either direction. If you take a look at the 2-line version of it, we're trading right around the one big volume node it has for the past year, right in the smack dab in the middle of the value area there. So in all the moving averages, the range of the past couple of weeks have been trading within all these moving averages. They're all pretty much going sideways there. As you can see, the RSI and CCI are right smack dab in the middle of their charts, and you can see the RSI has been between 60 and 40 for quite a while. So really not going much of anywhere there. The DMI, both the positive and negative indicators, are sitting in neutral levels. And then you look at like the Ichimoku cloud, and we haven't had a trend for a while. We had a little bit of a downward move there, but look at the weekly trend here. It's been minimal to absolutely nothing for most of this past year, as the stock has dropped and then rebounded and hasn't done anything. You can see we're trading right around the cloud, not really, the cloud's not moving up or down. The red line is trading right through the price, not really above it or below it. So we're just not trending, and that generally leads to an opportunity for an iron condor spread. So when you look at like selling the 20 deltas, which is what we do 20 to 50 days out, so we'll go out to May, sell the 470, buy the 465, sell the 515, sell the 515, buy the 520. That sets us up, and for a full position size, so we don't have to worry about earnings. That sets us up with this return, and you can see where here's the Bollinger Bandwidth as low as it is. The band's well inside the Keltner channels, and you can see the break evens there right around the range of the past so many months, plus or minus a little short-term moves outside of that range. But for the last 6 or 7 months, though, these are kind of right outside of that range. So it would take a trending move to get us to a loss one way or the other. We want to be out of it anyway in that regard. So that was our trade idea for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply in anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com for free. Follow and like us on Twitter and Facebook and LinkedIn as well, for that matter. Have a great rest of your week, everybody, or Monday night, excuse me. I'll see you again on Wednesday, but have a great rest of your Monday night, and we'll see you next time.